Welcome to USMK Insights, where we focus on US stock technical analysis. Using charts, trends, and price action will help you understand the market rhythm and make informed buy and sell decisions. Alright, hit subscribe and let's begin today's learning journey.
Hello everyone, welcome back. Today we will continue discussing reversal patterns. Earlier we talked about the engulfing pattern, a type of reversal setup. The engulfing pattern is one kind of reversal signal. Today I will introduce another reversal pattern. This reversal pattern is the opposite of the engulfing pattern in structure. As mentioned earlier, the inside bar pattern is the exact opposite of engulfing. Here's the key difference. Let's take a look at this setup. We previously explained the structure of an inside bar. For example, a bullish candle followed by a bearish one, or a bearish candle followed by a bullish one. The second candle must be larger than the first. Its upper and lower shadows, as well as the body, must fully contain the prior candle. But in this case, it's exactly the opposite. This is a reversal pattern based on the inside bar. So what is an inside bar reversal? It means the first candle is larger than the second one, and it completely contains the higher and low as well as the body of the following candle. This is what we call an inside bar. It's the exact opposite of the engulfing pattern. The first candlestick is larger than the one that follows. That's called the mother bar. The one after is called the inside bar. The mother bar fully contains the entire inside bar. Just like being pregnant, it's carrying a new candlestick inside. This is what we commonly refer to as a reversal pattern. It's also a very common setup we see in actual trading practice. Let's take a look at this example. Here we see an inside bar reversal pattern. Here is a similar setup right here as well, though the high is similarly above the previous one, so it's not a perfect example. But this one later is much more precise and clean. This earlier setup here is an engulfing pattern. We can see these first two candles form an engulfing pattern, while the first two candles form an inside bar, the opposite structure. In one, the first candle is smaller and the second is larger. In the other, the first is larger and the second is smaller. So how do we use this reversal pattern to determine the market trend? Let's look at the earlier price action. There was a strong continuous uptrend at this level, a clear bullish trend. Bullish momentum was very strong. Then an inside bar pattern appeared here. An inside bar formed at this level. This indicates a shift in momentum between bulls and bears. Power began to shift between the two sides. As one weakened, the other grew stronger. The bulls were losing strength here, while bearish momentum was building. At this point, the market reached a balance and entered a consolidation phase. Now, under what condition does the inside bar reversal hold? When does it become valid? If after the inside bar, the next two candlesticks both close below the low of the mother bar, especially below the large bullish candle's low, then that confirms the pattern. We can then say that bearish momentum has overtaken the bulls. At this point, the inside bar pattern is confirmed, and the bears take control of the market. They now guide the direction and trend going forward. This completes the shift from bullish to balanced, and from balanced to bearish dominance, a complete transaction. This is what we often say a reversal pattern acts as a link between past and future price action. It bridges the transition from one phase to another. And in this transition, the reversal pattern plays the role of that connector. Isn't that clear and simple? Many friends often ask me, when is the best time to sell? At what point should I go short? How can I accurately find the bottom? I get asked these questions all the time, and I always say, learn reversal patterns well, then you will be able to easily identify the peak in an uptrend and the bottom. You will be able to spot the bottom of a bearish trend right at that turning point. So the purpose of studying reversal patterns is to help us judge whether the trend is likely to reverse, whether bulls are turning into bears or bears into bulls. The key is Can you identify and grasp the reversal pattern and understand how to use it? Alright, let's continue. Here we see a period of sustained pullback as the price drops to a low point and inside bar forms again, right? This is a low point inside bar. There's a large bullish candle followed by a doji or small bullish candle. Together they form an inside bar. That big bullish candle in front completely contains all the candles that follow. They are all inside its range. That's what we call a mother bar, right? So we can clearly see that the mother bar forms an inside bar pattern. This is the inside bar setup at that level. So how do we actually trade an inside bar setup? We wait for the following candlestick to break out, especially break above the resistance level, the high of the mother bar. If the price breaks above that high, then the inside bar pattern is confirmed. At that point, we enter long trade on the breakout day. That's when we go long. And afterward, the price starts rebounding. Isn't that simple? So once the inside bar appears, we know the previous trend is starting to weaken. Then when a strong bullish candle forms, we can determine that the balance between the bulls and bears has been broken. That structure has been disrupted. With one strong bullish candle, the price breaks above the high of the mother bar. At that point, we can say bullish momentum is now stronger than bearish. The trend is moving upward. Isn't that very straightforward? Let's look again. Do we see anything at this level? No, nothing here. Let's look higher up. Here we have another inside bar pattern. Can you see it? This move was a strong rally upward, pushing higher and higher. After that strong rally at this level, a medium-sized bullish candle formed with an upper shadow. Then a much smaller candlestick followed. After this small candle formed, we can see clearly this is another inside bar pattern. Of course, when this pattern forms, it only tells us that bullish momentum is weakening. It doesn't necessarily mean the price will suddenly crash from here. We can't call it a confirmed reversal just yet, right? It simply signals that strength has shifted from strong bullishness to balance. A balance between bulls and bears usually leads to consolidation. It's like driving a car at high speed on the highway. If you want to make a turn and you're going 150 kilometers per hour, can you turn instantly? A sudden turn could crash the car, right? There's a process involved. What's the process? First, you brake. Slow the car down. Then you can make a left or right turn and start heading in the opposite direction, right? This is the same with stocks. If the price has been rising steadily from this level with strong bullish momentum, how can it just reverse instantly? It can't flip directions so suddenly. It takes time. And that process is what we call a reversal pattern, right? So when we see a reversal at this point, it shows up as an inside bar. That's a pattern. That's a reversal setup. But this kind of reversal pattern needs confirmation to become valid. It depends on the candle that comes after. If that candle breaks below the pattern support level, then we can say the earlier inside bar reversal is confirmed. So many people might ask, why didn't it work here? There was also an inside bar at this level. Yes, we see an inside bar here, but why didn't the price drop afterward? Does that mean this method is unreliable or nonsense? Let's look closely. There was an inside bar here, but what about the next candlestick? Did it form a bearish candle? Did it produce a strong red candle? No, it didn't. Without that follow-up confirmation, we can only say bullish momentum is weakening, not that a reversal has occurred. We must wait for the next one or two candles to show the right kind of confirmation. Then we can judge whether this inside bar pattern has actually formed. You need at least 3 candlesticks. These 3 candles must work together to reflect the shift from strong bullishness to balance, then to bearish strength. That kind of transition doesn't happen easily, right? It's the same when the price is at a low point. Look how strong the bearish momentum was earlier. Then a bullish candle formed at this level. A large bullish candle appeared. Then came two consecutive small candles, very small candles. That signals the formation of an inside bar pattern. Once the inside bar forms, it only tells us bearish momentum is fading, but it doesn't confirm a reversal yet. We still need a follow-up candle for confirmation. What kind of confirmation? A breakout above the recent high or a break below the mother bar's low. The larger the confirming candle, the better. And if it breaks below the mother bar's low, the big candle before the inside bar, once that low is broken, we say the inside bar setup is valid and the trend is about to reverse. A shift from bullish to bearish. The trend changes direction from up to down. At this point, we can enter a short position. We can start shorting. Place your stop loss above the recent high, and that's it. Then trail your stop to lock in profits, right? Once we identify a reversal pattern, we can accurately trade near the top of the shorting opportunity. Same thing here. We short at this level, then ride the downtrend. This entire short trade opportunity is captured by us. We lock in this full downside move. That's exactly what it means, right? Isn't that clear? Now, of course, if we combine this reversal pattern with the KDJ indicator, the outcome can be even better. So how do we use it? Because the KDJ indicator represents a cycle of a market move. For example, the shift from a KDJ death cross to a golden cross marks a full daily level correction. This is very helpful for setting stop loss and take profit points, right? Whether you use KDJ or MACD, both indicators are suitable. They work fine. For example, after spotting a reversal pattern, we open a short position during these 2 days, right? At the same time, we see that the KDJ indicator here is forming a death cross and turning downward. This tells us we're likely entering a daily level pullback. It may last about 3 to 4 weeks. So what do? We keep holding the position. Hold until when? Until we see a golden cross. The golden cross happens around here, right? Around this area. That's how we capture the entire move. Isn't that right? If you're using the MACD indicator instead, then in that case, it may react a bit more slowly. So your exit signals might also lag slightly. You might exit around this area, right? If you want more precise timing, something more responsive, use a KDJ indicator. If you prefer to capture full swing and avoid too many whipsaws from noise, then MACD is a better choice. Using MACD here helps you capture a significant downtrend, a great short selling opportunity. That's what we mean. Make sense? Alright? So you can combine and learn from both methods. Use reversal patterns together with the KDJ indicator. That gives you a complete trading strategy. Sounds good? That's all for today's session. See you next time.